And good fund managers still perform in bad markets. Yes, the distribution may take long, but we really find that there is a very strong correlation between the person you choose and the good fund manager. And there is some variance, but very rarely does a manager go from being a top tier manager to the bottom tier. That's quite unusual. So we believe, and over relationships, you're not always going to have the number one, top 1 or 5% returns. So you had to also be a little bit more, I think, longer term, holistic approach to when you're investing as well, and think about why you're investing and for what time period are you investing. I think family offices think about investing longer term. We've been doing this now 25 years. I hope it continues. I think obviously my children have money in funds as well. Next year I'm going to be for the first time a grandfather. I'm really looking forward to that, and I'm sure they're going to be lucky to have some investments that are certainly all going to work hard, and we can deal about all that transition and work ethic issues, which I think is the most important thing in culture.
Hey guys, welcome to VNTR Podcast, and today we are hosting Russell Deakin. Welcome, Russell, to VNTR Podcast, and we would love to learn more about you. Maybe you can start first with a quick introduction.
Nice to see you again, Yuri. Thank you for the opportunity to speak with you. It's always a pleasure. I'm Russell Deakin. I am a founder and the CAIO of a single-family office called Aceana Group. Just a little bit of background about me and the family. We are a British Brazilian family. We mainly reside in Miami, but I'm actually speaking to you from southern Brazil at the moment, a city called Porto Alegre. And here we have two operating businesses. One is a real estate developer, and we also have productive farmer and growing rice and cattle. So I spent 11 years living here in Brazil, and we come often, but we've been in Miami the last 19 years.
Amazing. So maybe we can step back into the background of your family. How did you guys get started? Is it multi-generational, or is it you who started these businesses?
So it actually has two sides of it. So on the real estate side, it's multi-generational. I was the third generation. I was the CFO and real estate of the real estate developer. That was founded. We're actually grown quite a lot, really, by my father-in-law in Brazil, and we have real estate that's focused on commercial as well as residential. And I also feel like I'm G3 of G4 on the real estate side, but G1 of G2 on the tech side. And the reason for that is I actually became a partner in Latin America and Brazil's oldest venture capital private equity firm. And from that, we had tech funds. We were very early investors in the internet. We invested in one which you may not remember. It's a while ago now. The equivalent of Netscape was a web browser called became Terralycus. We invested with them very early in seed stage. I actually then started also investing off of my own balance sheet in 2006. When I moved to Miami, I was the only foreign partner. It's a long time ago, but I believe I was, if not the first, one of the first foreign partners in a Latin American private equity fund. And then we moved to Miami to raise money with the American institutions as well. And then from that basis, started investing in dollar off my own balance sheet to diversify. And then from really 2011, I've been doing that full time, making my own investments for myself.
That's great. So you mentioned that you're CIO at single family office. So what does it mean, to the audience? Like,
there are two real definitions that you'll hear. One is a single family office, and one is a multi-family office. So a single family office, like I am, we do not administer money of other people. We just run our own family money, our own nucleus family money. So we don't have external clients that we're running money for. Where multi-family offices do that, they have assets under management of third party, and we do not.
And what is the construct? Like, how big is your team? Is it just you? What are the elements that construct the family office?
We actually, we're fairly small. We have 6 people. We have 2 actually in Istanbul, 1 in Brazil, and we have the other team member. I'm obviously in Miami, and the other team members are in San Francisco. So we have actually a 10-hour time zone difference, which we like because we're able to get projects done. And even though we're small, we are almost functioning really 24/7 because of that. So strategically, I did that for a reason. We invest internationally. We have probably about 70% of our investments are in the US, but we also invest in Europe, India, Singapore, and obviously Latin America. We have legacy. So on that basis, it's very helpful to have the team members on different continents. And we spend a lot of time in Europe as well as obviously in the US and Latin America.
That's cool. Yeah, so we meet a lot of high net worth individuals that consider to launch a single family office, right? It's kind of to manage it more effectively, their capital and investments. So when did you decide to form the family office, and what did it take you to establish it?
So I think, like most, I would say the majority of family offices grow organically. So I started doing this myself, as I mentioned, sort of 2006. I did my first investments off my own balance sheet. And then I realized when I stopped working as a partner for the other private equity funds that I was going to do this more full time, as it were. It is my full time job as the CIO. I realized that I couldn't do it all myself, and I needed to get help from that. And I also wanted to make sure I had an international footprint as well. I, started investing as a VC, as a principal in emerging markets in Brazil and Latin America, which perhaps is a little unusual, but we were always global. So that was something I wanted to do. And from that basis, realized quickly that it made sense to have a team to help, to in essence help me, and that's the difference between being a high net worth individual and then creating a structure where you have people in essence working for you with your professionalizing the whole investment process.
So we also see some family offices where the CIO is not the principal of the family. It's kind of you chose to be the CIO as part of the family, but when do you bring an external CIO to manage the funds?
I'm not sure because I enjoy doing it. So I've been an investor for many years. So maybe that's a little unusual too. Perhaps when I get older, when I really don't feel like doing this anymore, I enjoy very much meeting very interesting people like yourself, Yuri. We met in Davos. I say it's a very fun job. I don't even really consider it a job because of that. I do play sports. So I'm quite active, but I could not think of just not doing it work. Intellectually, it's very satisfying, culturally, and I think I will be doing it for many years still. So that's just my own personal desire to be more involved. And we do not only invest in funds, we do co-investments as well. So that is something that I believe perhaps with a generation shift, perhaps my children, the young adults now in the early 30s, they have their own careers, that we do things together, but they're not officially part of it full time. Mm-hmm. That may change. It's not something I demand for them. And if it gets to a point where we have that generation shift where I no longer want to work, then that might be the time. But I hope that's a few years away yet.
Yeah. So you mentioned that you're investing in emerging markets, but is there any sector focus as well where you prefer to invest?
So we had tech funds when I was a VC. So I consider myself a generalist, but with a tech focus. So we've done, for example, some of the sectors that we've invested in include fintech, include AI, deep tech, blockchain. Also, we've invested in digital health, med tech, ed tech, space tech, SaaS, and climate tech. Probably missing one or two, but we started in 2006, which I think is quite typical. The first fund we did was a fund of fund. And it was a very successful fund with the top funds in Silicon Valley. I think it was a good first step because you got to learn the process, and it gave me a diversification of managers, obviously. And then you begin to invest in managers. And I think generally you start with general managers, and then as you become more mature in the whole investment process, you then start looking for managers that really have an expertise in certain sectors. And we have done that. So we go down these verticals. I think that's very helpful. It's proved to be very, very profitable. And we like to have managers who really understand the verticals and sectors. And we like to invest in those smaller managers generally. Most would probably, which is a bit unusual. I'd say 60% of what we do is in venture capital. So that may be quite aggressive to others, but if you set up a long-term program, which we have over the years, you get distribution, so you create liquidity, and fortunately, we've been very successful in the venture capital investments. So we have good returns, very good multiples, and that leads to you having money to constantly reinvest. Yes, distributions have slowed the last couple of years, but I actually think they're beginning to pick up again. And then we've changed a little bit over the last few years, and maybe that's as I'm getting older. A friend of mine kind of bluntly told me I'm now at my QTR phase of life, and I'm like asked him, what does that mean? And he said quality time remaining, and I'm like, ouch, that one's hurtful. So I just turned 60. I'm a very active physically. I hopefully mentally, physically, I have a good 20, 30 years at least. But what we've adjusted slightly, we have a portfolio of probably about 15 or so funds and 50 to 60 direct co-investments. We have already created those direct investments. A lot of them were angel investments in early stage. And what I've learned over the last few years is if you get to learn and know a fund manager very well, which we often are repeat investors in funds. In some funds, we've invested 3 fund cycles. If they've proved themselves, what we now like to do is do co-investments with those fund managers on those portfolio companies that are successful. Those successful companies have pivoted, they've been professionalized, they've been through the gauntlet, and generally they need money to grow. We don't just do it blindly, but we choose. And fortunately, as a family office, funds like family offices because we can make a decision fairly quickly. Depending on the risk, we'll vary the size of the check. But that ability to invest in successful portfolio companies as co-investments with those smaller fund managers has proven to be a good way to increase returns and alpha, and frankly also to work a little less. Doing direct investments take a lot of hard work, so I let them do most of the hard work, and then I come in hopefully and helpfully with them, not just money, but with my international contacts, etc. And that's an adjustment we've made over the last few years, which has proven to be successful.
So you're very active as the LP. What do you look for when you invest in a new GP that you didn't know, right? What is your strategy to find the fund and then make the decision to invest in that fund manager?
I say the following. I don't think it's that difficult to find the certain trends that are happening. Obviously, we've mentioned a few of them: fintech, AI, blockchain, deep tech. Yes, you have to be careful a little bit of FOMO, or fear of missing out, and make sure you're not over paying for those assets. But this has also changed slightly. The most important thing for me is actually more the soft issue, and that is the person has to be a good character. Obviously, morals we had to have a chemistry with that person. I think that soft chemistry has become more important than perhaps 20 years ago when I just thought about doing track record and strategy, because things change. We go through cycles, and I've learned that a good person, no matter what's written in the contract, will do the right thing, and often better, and a bad person will not do the right thing no matter what's written in the contract. So I think that's really a very, very important aspect. In terms of, we then look at obviously trends and strategies. We talked about some of the sectors that we've discussed. And frankly, we are betting on people. We're betting on the jockey. We're betting on people who can execute. So I do look for people who have had very strong previous track record. It can be at another firm, it can be at a spin out, but they have to have a good track record of investing. They can be first time managers. I've done that. But they cannot be first time investors. And then where we finally look for it, where do we find the flow? Well, we do a combination of a couple things. We do go to quite a lot of conferences. You and I met obviously in Europe. Just to give you an idea, last month I was in Europe again. I went to the Super Return Berlin, the largest venture capital private equity conference in the world. We went to 4 family office events as well. So I spend probably 40% of my time speaking to fellow investors, generally the family offices, but because I also was a fund manager, I many years ago now, but I still maintain very good relationship with institutions, endowments, and other, it could be foundations, pension funds, and we exchange ideas. And basically, another thing that Yuri I've learned over time after being turned down by so many fund managers, it's not that difficult to find the top fund managers. It's very difficult to get into some of the top fund managers. Now, we do emerging managers, and we hope they're going to be, we like that. And the risk, we like to have a asymmetric reward risk. And we find on some of the emerging managers, we do that, and we've done very well on that. But some of the larger, not the larger, but the more successful names, what I've found is you can help people first. So I really like to talk to fellow investors, and I'm more than happy to share the names of what we've done, why we've done them. And frankly, if you tell a fund manager and you're an LP in the fund, treat my friend nicely. I know you may be oversubscribed, but make room or consider creating a long-term relationship. They should do that. They really would. And so I do that, and I'm happy to introduce. I mean, everyone has to do their own due diligence, obviously, number one. But I'm more than happy to, and I do this a lot, introduce people, friends of mine, to the funds that I've invested in, and then I ask them the same favor. Well, are the funds that you know that you've invested in that would be potentially open to having a new family office? And that way, you can't be best friends with, the 10 most successful fund managers. You can't go to school with the 10 most successful fund managers. And obviously, we can define what that means. But what you can do is create and expand your network by doing that same sort of helping each other. And that's proved very helpful for us. And that's how we've managed to be, I think, more successful in expanding our network and finding good fund managers, because speaking with fellow LPs is very helpful.
So when you invest in emerging GP that is on his first fund, and then he comes to you and raising the second fund, what are the metrics you're looking into that will convince you to deploy again in the second fund or the third fund?
So, and that happens to us. One of the fund managers that we've invested in was probably the worst pitch book I've ever seen. And I was perhaps just very transparent because that's the type of person I am. And I said, look, the pitch book's not helping you. Just put it away and talk to me. I'm terrible at doing pitch books. I still do, skeleton figures. Just let's chat. Long story short, I invested in him, and it's probably going to be a 10x fund on fund one. Mm-hmm. Now, that's not realized. So they don't have to realize it's the venture fund, obviously. It takes time. Again, depending if it's early stage, seed, and we're generally doing more earlier stage. I think that's where a lot of the alpha is. We're generally underwriting it these days at almost at least a 4x return, net return. Now, an IRR above 25% net, again, doesn't necessarily have to be realized, but there's got to be significant increase in the NAV of the portfolio. And frankly, one of the funds I've just invested in, which is unusual, in year 4, we're expecting is being negotiated to get 60% of the DPI back in year 4 of a seed fund, which is very unusual. So sometimes you find, usually it's like 5 or 7 years. 5 years, you start getting some money back, and then it can be 7 to 10 years before you get everything back. So you have to be patient, but you need to see, I think, real appreciation that can be verified in the portfolio. So we don't necessarily have to have realized returns, but we need to see that they are real increases in returns.
But oftentimes it's just 3 years in and they're raising the next fund, right? And they come to you and they invite you to chip in.
Well, we may skip. Frankly, we skip often. We just did that. We did fund 1 and fund 3. We skipped fund 2. And they had to be comfortable with that. And I said, very honestly, look, we'd like to continue to invest, but just not at the moment. We will probably invest in your fund 3 when you have a little bit more, progress that we can measure. And they also had to be willing to hear that, because if they said, well, no, we're not interested, they cut a relationship, and that would be, I think, silly, because frankly, when you invest in the fund, again, you tend to invest more, right? So GPs need to be patient with LPs as well.
Yeah. So it's not the same like with startups, right? If investor doesn't follow on, there is some negative signal for other investors, right?
Yeah.
You see it that it's quite common that LPs may skip a fund and then come in again because they see good performance in the previous fund. That's cool.
Well, especially in the seed funds, in the early stage VC funds, because it takes longer to get traction.
Yeah.
I think in terms of, if it's a growth capital fund, we do growth capital funds as well. We tend to do more VC, but then that's a little bit easier because you're getting more traction quicker, more DPI, right? And DPI does matter. It really does. And it has slowed down the last few years. I'm getting now the last couple of months, we got a few distributions. And I do think it's beginning to pick up. So I think that's the question. If all of us are in a long-term game, so the fund managers need to realize those relationships as well as the LPs. And I like and try to commit 2 or 3 funds at least. And that's maybe a little different than investing with a large institution or a sovereign wealth fund that has money coming every year. That's different. And I think there's advantages, obviously, for especially venture capital funds, smaller venture capital funds where we tend to invest. They often can't get the money of the larger sovereign wealth funds because those funds are too small. So family offices are more flexible. We like to do co-investments in general. So I think it's a closer relationship, but it's also realized that we, as a family office, we had to generate own revenue and assets. Unfortunately, I don't have oil underneath my home.
You mentioned that co-investment is a big thing for you, kind of to co-invest in the best deals with the GPs. Are you looking to invest directly in the companies, or you're fine to invest through a feeder SPVs that GPs launch? What are your requirements, or do you agree on these terms before you join as LP as well?
Well, generally, yes. So we happy. It does vary. So one of the funds that I invested in, we have which I think is a very unusual relationship, and maybe it's becoming more so, where we don't get charged either management fee or success fee. We do co-investments with them. I'm introduced to the CEO of the companies. I've gotten to know them because obviously they're in the portfolio, and then we just go directly on the cap table. Other times we will be through an SPV. The fees vary depending on the size of the check. Obviously, those who put in a huge check probably get some discount. So again, that varies, and we're comfortable with that because we won't cut off our nose to spite ourselves. We live and breathe net. So just because someone's charging me fees doesn't mean I won't do it because of fees. If it's a very good deal, I pay fees. I would be silly not to. It's the access. We have, fortunately, knock on wood, uh, I've never lost money in a fund and never lost money doing co-investment with a fund manager in a successful follow-on. But I have lost money doing a direct investment by a sponsorless fund or even sometimes outside of a fund. So we're a little bit more careful about that. We generally don't do that. The bar's higher. And I also think, frankly, that for me, as I mentioned before, I have been on boards before. I have done directs because I used to be a venture capital. It takes a lot of work, and I don't want to do all of that work anymore. I'd much rather have the fund manager do more of that work for me. So for us and our family, we're perhaps a little bit more passive. I try not to be on boards anymore.
And you touched on fees. Many people say, "Hey, venture capital should change. The fee structure doesn't work. LPs, GPs are not aligned." What do you think about the fee structure? Like what is the common 220 versus what it should be, right?
Right. So I think 2 and 20 is obviously the industry standard in general, and I'm very happy with the good fund managers. And again, it doesn't just mean the very well-known fund managers, because I've actually have a strong track record with smaller emerging managers in addition to the fund man. The size of the funds on venture funds are small generally. 50 to 200 million, maybe up to 300 million. Frankly, any fund more than 500 million on a venture side, I don't think they're really doing pure venture, what I consider venture. You could obviously argue that, but we do more seed and Series A. So they have to pay their team, and you want them to have a good team. And so even when I was a VC, I remembered if you nickel and dimed the portfolio companies and didn't pay them enough, you don't want the head, a partner of a VC or a portfolio company to call you and complain that he can't, clear it. I'm just giving a very extreme example. Can't clear a check and pay for the insurance of his family because he's not getting paid enough. That's silly. So I think you can be too cheap. So maybe we're a little different. Yes, we have had some adjustments. We've actually done a couple of times where we've taken small GP stakes in very small startup funds, and maybe then we're not paying the 220. But in general, there is some negotiation. Absolutely. If you're an anchor, if you're putting a huge check, there should be some negotiation. But I actually think the 2 and 20 model for VC fund, I think in general is fine. I would question that when there's a huge $30 billion fund. I don't think they need the 2 and 20. I think the VC, the less than $300 million, does need that to get the best people working for the team, which is most important because in the end, everyone should care about the net returns.
Yeah, I agree. And you had some experience with the fund of fund structure as well, right? So
I have.
do you see fund of funds as a viable mechanism for LPs to invest in, and when?
It can be, and I'll give you two examples. I think it's increasingly difficult, but also the funds of funds are creating new strategies. Obviously, co-investments, where they charge less fees. They've adjusted their fees, and they should adjust their fees. But I'll give you two examples of when we use the fund of fund. One in 2006, when we were just starting. We wanted diversification. Perhaps I didn't have enough money to invest in the 20 funds and the minimums. We didn't have access, and I was willing to pay for that. And that was a very good investment. And in the net, it was more than a 3x net return. So we were very happy with it. And just recently, we invested, well, now probably 6 years ago. But when we first invested in blockchain, we did a fund of fund approach because we wanted to learn about the sector. So when you're going to a new sector or a new geographical region, I think it's an inexpensive way to make sure that you don't lose a lot of money. So we use it sometimes when we go into new sectors, as we said, blockchain or new geographical area. And so I think they're still viable. What I think needs to be discussed, and where we did negotiate it, we actually, I think there is room for negotiation on the fees, and they seem to be quite flexible on that. And so it's certainly not even close to 2 and 20 or even the 1 and 10. And on that basis, I think there is still it's a legitimate product for different reasons, whether people just starting or going to new sectors or new geographical area. I still think the plain vanilla fund of fund obviously are struggling.
So with fund of fund structures, do you build relationship with the fund managers? It's kind of as a strategy, and then in follow-on funds you may come in direct, right? Because this way you get to see many funds, how they perform as LP, right? So in a way, it's like a co-investment, but into funds. And then later stage, you build relationship with them, and then you start co-investing in startups. So like this could be a safe path to learn.
It's a very safe option. I'll give you an example. I actually even use it for a core piece. We do a lot of venture and a lot of growth, mostly, as I mentioned, 60% venture. But we actually even use today a fund of fund. And I'm happy. I know we're part of the VNTR Society. Very happy to share with people offline if they want to talk to me more in detail. I like sharing. I like learning. It's the most enjoyable part of what I do. But I won't mention specific names on this call. But we actually invested in a fund of fund, believe it or not, and you think, why would I do this? That invests in the top largest buyout funds in the world, the top 50 funds. And people, well, Russell, you're doing venture capital, you're doing growth capital. But yes, that product for me, and actually they build in liquidity after a couple of years, so there is ability for me to invest in 2 years, and there's a market maker, so I can sell it probably at a small discount. But I actually have been approached by them. No, Russell, you're welcome to liquidate if you want, which I don't need the liquidity. But to me, that's a product that gives me a proxy. If you look at the last 40 years, the MOIC is from 1.6 to 2.1x for these large buyout funds, 400 to 500 basis points over the S&P. So for me, it serves for me as a proxy to the S&P with a 4 to 500 basis point pickup, or also a synthetic ETF to the private equity industry, the buyouts, which is a nice core piece. But then I obviously get a lot of alpha by doing investments in venture and growth capital. So even someone I've been doing this for 25 years, to me, that is sort of my rainy day money. And my wife said to me the other day, she was getting a bit nervous. There's obviously been a lot of macroeconomic, global political issues the last year, unfortunately, with wars, which is quite nerve wracking. And she said, well, is this safe? I said, well, if the top 50 private equity funds and a fund of fund blows up, trust me, everything else has blown up well before that, and we'll go live on our farm in southern Brazil, and I'll be a farmhand. Don't worry about it. So that is literally my rainy day. I hate to use that, nuclear war type of money, because that's going to be a very safe haven for many years. So I think people can look at different products, and we all have different profiles as a family office. And I think people would be surprised to hear that I have that product. But then when you listen to the reason behind it, it makes sense. So again, a fund of fund, and has a legitimate, I think, a legitimate tool to manage your risk profile. In this case, the liquidity profile is very interesting as well. And so we're always looking to go for products where there's an asymmetric reward risk. We've gone more on the alpha side. You may or may not remember, Apple went public at 300 million. Google went public at $1 billion. Uber 53 billion. So over the last 10 years, we've moved more towards seed and Series A to capture the alpha. And I'm not saying there's not alpha in some of the larger funds. There are still, depending, but it's harder to get. Where on the venture capital side, despite some of the headlines, we continue to have, our returns are in excess of 3x net over the years, and we'll continue to do it. We'll do it adjusted on the tail when things we think are very attractive, or it's going to be a good vintage year. And I actually think 2026 will be a good vintage year. Prices have readjusted. I think interest rates will slowly come down. So we are realistically optimistic, but we continue to invest every year, and then we'll on the tails we'll speed it up or slow it down, be a little bit more higher cadence depending on what we feel. But we continue every year.
Yeah. Great insights. I communicate with other family offices, and many of them kind of slowed down on venture. In the past 3 years, they say, hey, we invested in few funds. We are waiting for liquidity. Now we are looking for more liquid assets, liquid opportunities. Many of them, go towards real estate, like development stages in real estate. Do you think it's wise to kind of stop investing in venture? If you already invested in VC funds, is it wise to kind of slow down rather than kind of keep the pace? It's same like investing in startups, right? Like you as an angel, you invested in 5 startups, you see that it's they're not performing well, and many stop doing angel investing at that stage. Is it wise to not diversify with funds as well? Yeah.
So I would say the following with a caveat: every family office is different, right? We, for example, we have, as one of our core businesses, we have a real estate developer. So we have yield, right? We get yield because we have tenants who pay for rent. We also have a productive farmer, and every year there's a harvest. So rice and cattle and meat is, every year is sold very well in southern Brazil. So for us, and I do believe one of the things when you're setting it up, and certainly with even more as you go smaller to angel investments and then seed, etc., you need to think about doing this on a constant project. I think it's very unusual for someone to get the first 5 investments right on direct investments or co-investments or angel. So that's why we have 50 or 60. And I've had donuts on angel investments, a big zero. But but I've also had a return over 30 times, and so that pays all for the donuts. That's part of the process. But if you even think of statistics, I think the minimum number for the variable of n is 30. So if you don't have 30 investments in your angel investments or your direct investments, you have a statistical risk, and you're not going to get probably the medium returns that you should statistically. So therefore, I think you need to think about being, at least if you start, you need to be able to get to those sort of numbers to continue. So that's something that I think people should consider.
In terms of VC funds, how many funds do you think statistically you should invest in?
Maybe it takes a bit longer, and so I think I say a minimum of 15. I think so. And then on that basis, you have and maybe the repeat with the same manager. It doesn't mean you have to have 15 managers, right? Because we have repeat. But I think so, and if you maybe you say the minimum I'm going to invest in one manager per year in a VC, even if perhaps it's a bad year, and maybe you change to 2 or to 3. Obviously, it depends a function of how much money you're willing to put in, et cetera, et cetera, et cetera. But I think every year you should do at least one, and then you move from that. To stop completely, I think can really perhaps warp the statistics. And good fund managers still perform in bad markets. Yes, the distribution may take long, but we really find that there is a very strong correlation between the person you choose and the good fund manager. And there is some variance, but very rarely does a manager go from being a top tier manager to the bottom tier. That's quite unusual. So we believe, and over relationships, you're not always going to have the number one, top 1 or 5% returns. So you had to also be a little bit more, I think, longer term, holistic approach to when you're investing as well, and think about why you're investing and for what time period are you investing. I think family offices think about investing longer term. We've been doing this now 25 years. I hope it continues. I think it's obviously my children have money in funds as well. Next year, I'm going to be for the first time a grandfather. I'm really looking forward to that, and I'm sure they're going to be lucky to have some investments that are certainly all going to work hard, and we can deal about all that transition and work ethic issues, which I think is the most important thing in culture. But I think you have to look at this as, certainly as a family office point of view, as a multi-generational process. We do, and will continue to do so. So my suggestion is those who are going to start, I think it has to be at least a 10-year plan. At least they're going to do, to start. You don't want to stop after 1 or 2 years.
Yeah. And in terms of geography, right? So you invested mostly in US funds or like European, other regions?
So I would say we have 65-70% in the US, and then the other regions include Europe, India, Singapore, and Latin America.
And where do you see most potential? Like you could invest in the best funds in Silicon Valley if you could get in, right? But
yeah, and we got in through co-investing years ago, but they've also, some of them have shifted. They've gotten very large, and we have not continued with some of them because of that. I don't think that they're sticking to what they did very, very well. Some have, some not. Obviously, actually, I'm going to Silicon Valley next week, and we'll have some discussions with some managers, some new ones, some old ones, and continue to evaluate that. I do think that price points, the U.S. still has a very unusual ecosystem, and it's not just Silicon Valley. We invest outside of Silicon Valley. We invest in VCs and sometimes not as well known. Obviously, Boston's known, Silicon Valley's known, but we've invested in places in the Carolinas, in Texas. So it varies, and I think that's important. So U.S. will continue to be a large portion of our portfolio. We have invested for the first time, taken a stance in India. We've done one manager that I think will has a good track record, actually has a good DPI with one of the oldest. We'll see how that goes. I think India does well technology. Obviously, there's some very strong demographics. We've invested specifically in a blockchain manager in Singapore. Singapore is one of the leaders in terms of blockchain. In Europe, we think there's value there. We have invested and will probably continue to grow that. So it's really the specifics of the manager and the verticals. I think in general, you can see opportunities and then connect the dots. I've lived on 3 continents, and so we like to look at things and say, well, and you have to certainly adjust it. But if that's worked well, some of the price points in other markets can be cheaper. That could be Western Europe. The one thing that I would say that for example, and it's my own personal opinion, people may not agree with it. So we decided to do India. We didn't feel comfortable doing China, more because of the macro political risk. People may disagree with me, but I did not like that political risk. We also have so far, and with the one exception of Singapore and a specific blockchain fund, we've held off at the moment, but we'll probably move eventually. I don't think there's quite enough distribution in Southeast Asia. There's not enough DPI yet. We haven't seen that. So maybe when we first went to India, we sort of said, no, we're going to hold off on that. So it does a no now doesn't mean a no in the later, but I think that question is seeing how certain markets mature or still need to be mature. That is a process as well.
You mentioned like 60% goes to VC. What other asset classes do you deploy into?
So I exclude real estate as a private asset class because we have that as an operating. And that's probably quite different than many other family offices who probably the first thing they do in alternatives and real estate would be to put it in real estate. Well, since we have that operating business, we don't include that. We've done growth capital. We've done recently a pan-European fund, which was an energy net zero transition. I think investing in, for example, sustainable aviation fuel plants in the Baltics, in Germany. I think Europe in general is far ahead of the US in terms of energy net zero transition. That there's good tailwinds there. So that was growth.
How does it work? The investments in energy zero.
So they'll invest, for example, they'll do a lower middle market buyout of a sustainable aviation fuel facility. This one happened to be in the Baltics. They'll take it over and running. One of them had a solar distribution plant as well. So they're actually taking real assets. So for me, that's a very interesting asymmetric risk between, hopefully, targeting above 3x returns, but I'm getting infrastructure risk because the real assets, they're over collateralized. So if things don't go well, they can sell the assets, right? I'm not saying there's not some risk. Obviously, there's risk, but that's another example where we believe there's asymmetric risk between the upside and the downside protection. Sometimes we like to be later in funds. I think as a family office, it's really an asymmetric risk. We like to see the portfolio develop. To give you one example, a gentleman spun out of a corporate venture capital. Corporate venture capital generally has less defaults because the exit is already planned. So this was a first-time fund manager, but not a first-time manager. He had a very strong track record with corporates. He set this up. And why did we invest in that? One, I thought that was interesting, that approach in setting up his own fund. But one of his portfolio companies actually has a very interesting, he was at Davos, and you might have met him. He has an interesting company that makes a biodegradable plastic, completely biodegradable plastic shopping bag and cloth bag in 30 seconds. There's 5 trillion shopping bags made per year. So he's already got more than a 5x bid on his original investment, and that's in his portfolio. So to me, that's a nice anchor to have in the portfolio, de-risk it even more. And we believe these days, I did a renewable energy fund in 2011, hydro and wind in Brazil. I think perhaps at that time it was mutually exclusive. You couldn't have a good impact, save the world as it were, and make money. I actually believe now you can. There's good tailwinds. My son's actually doing a master's right now in engineering renewable energy at Stanford, so he believes in that, and I think it's going to be a very good tailwind for a career. And so that's what we're seeing now, especially in Europe. There are, and generally environmental. Yes, some of the early climate tech funds didn't do particularly well. We waited, but now I think there's some opportunities into doing well. So that's an example as well.
There is a guy that has biodegradable bottles that I should introduce you to if it's of interest for you.
You can put them in the bags.
Yeah, exactly. Why focus only on bags if you can also do bottles? Why didn't you expand in your core business to other regions, right? It's like you're strong in Brazil, in real estate, cattle, farming, like rice. Why didn't you create like a larger company around these assets, like in other markets?
Yeah, I mean that's the extended family. So we bought a farm 30 plus years ago. My brother-in-law runs it. It's been a very good business. I think the following, and everyone chooses what to do. I think you can have a very good life. Brazil's a huge country, bigger than the continental United States. It can be complicated at times, obviously, but I think they're doing well. And not everyone wants to be global. Not everyone wants to expand. I think one has to respect that. The tendency is to get bigger and bigger, bigger. That may not be the best thing. There's certainly, I think, enough opportunities. Now, I enjoy doing things globally. I don't know, I was brought up on two continents, and then I ended up living in Brazil, so added a third continent. I like that. I like connecting the dots. That's just my personality, so I choose to do that. Not everyone needs to do that. There's different ways to be, as I say, rich in many ways. It's not just the monetary ways. I think the most important is how we feel inside, and there's many ways. I love visiting, but I would not want to live on the farm, and it's beautiful. But after 2 weeks, I go stir crazy, and I think my brother-in-law thinks I'm crazy that I want to spend time in a busy city, and can't understand why I like that. So people are different, and you have to respect that.
Yeah, 100%. So you mentioned that you constantly network, travel to events, meeting other family offices. How do you manage all these relationships, right? It's kind of one is to meet with them, but build relationships and maintain them and actually get value out of it is what you need
It's
to
difficult.
know. Yeah, difficult, but also if you know how to do it, then you actually capitalize on all this travel and
Right.
joy. So what are your best practices? How do you do that?
Two things that come to mind. Number one, you got to do it consistently. You can't just go once and show up and not show up for 3 years. So you invest in people. Obviously, technology has helped now. We have a good CRM system. We do a lot of, a lot of my team does a lot of time in the data management to see what people like to invest in. So you remember, but you can't remember everything. It's impossible, right? So you had to use technology. Zoom's helped because you can meet with them once or twice a year, and then Zoom continue the relationships. And I do that a lot. I mean, we're doing that today, right? So
Yeah, we spoke
that's good,
like 3 weeks ago, right? So
exactly. So that's helpful to maintain the relationship, but then you got to continue. So I'll go to Europe 3 or 4 times a year at least. I come down to Brazil 3 or 4 times. I'm obviously go to family office events, industry-wide events, and it is an investment in my network. It's an investment in my relationships, and I spend time and money doing it a lot. Because if you don't do it consistently, it takes time. You can't rush things. People, it's all about confidence, especially with family offices. That's why the social aspect of it is so important, because and that's the question of getting to know the character of the person. And you can't do that overnight, and it takes time. And I'm happy to invest in that. And so I always will say I'm a fast no, but a slow yes. And I think people need to understand that and respect that. And I think most people really are that way too.
yeah, I agree with you. And where you planning to travel soon?
So I'm coming back from Brazil Sunday, and then next Wednesday, Thursday, I'm going to a family office event in Silicon Valley. So I'll be meeting with some LPs, seeing some of my existing GPs, talking to the new GPs. And then after that, the following week, I'm actually there's a large family office event in Newport, Rhode Island. So again, it's a repeat event that I go to, and then we will map out the rest of the year. I know there's a couple of events probably in Europe I'll go to.
You should come to our Global Investor Summit on November 11 during Web Summit. So this is something that you shouldn't miss.
Put it on the calendar. What city is it in?
In Lisbon. In Lisbon.
Okay. I speak Portuguese, so it'll be easy for me.
And then we have also a retreat to Porto and Douro Valley, so that you should join. And how do you get to know about all these events? Like, let's say it's a new family office, someone had an exit, or they want to emerge into family office community. What is the best way you recommend to get started?
Okay, so obviously the most basic way you can Google this stuff. Some of it comes up, some of it, right?
Yeah, Russell, thanks for sharing all these great insights about venture capital. And what do you do for work-life balance while traveling so much? Maybe you can share some tips how to travel and enjoy life at the same time.
Well, I think it's never particularly in balance. There's moments where you perhaps work far too much and moments where you enjoy yourself. So I think perhaps overall on a time period, you hope that you have a better balance. And I think I'm getting better at it, working smarter rather than more as you get a little bit older with experience. We're fortunate. I mean, one of the reasons why we moved to Miami was for that work lifestyle balance. We moved to Miami almost 20 years ago, July of 2006. And to be honest, when I moved there, people used to tease me like, "Why are you moving there?" Kind of similar when I moved to Brazil. People are like, "Miami, what are you going to do? Just sit on the beach?" I'm like, "Well, actually, no." And after COVID, the world discovered Miami. It's gotten much more crowded than it used to be. Then there's pluses and minuses that go with that. So we enjoy the fact that we're quite physically active. Obviously, technology helps. So, like we're doing, I could do this phone call anywhere in the world. So I think I've learned to. I made last year a funny New Year's resolution, and it wasn't to eat less. It wasn't to drink less. I don't smoke, so that's not an issue. It was to ski more. So living in my ski more, I said I'm going to do at least 14 days of skiing, and people are like, "How can you do that?" Well, if you do it on the weekends, long weekends, etc. Obviously, we had a week or so. We were in Davos. We took a couple of days. Adding to those, and frankly, fortunately, with the family office, you often get invited to events that are in very nice locations, and then you can extend it, right? And maybe perhaps before, when I was younger, I wouldn't do that. I wouldn't take the Friday afternoon off. Now I will, but and then which I do, and it's just the way of my DNA. I often work very late at. Well, I think it's late at night. I'll often go to bed at 1 a.m. and I'll go back to work at 10 to 1. And people are like, "Why do you do that?" I said, "Well, my team's in Istanbul, two of them. So in order to prepare the work, I do that. But it's just the way that my body clock works. So you have to adjust to what you enjoy. I like exercising at the end of the day. Almost every day I do exercise. Again, living in a climate like Miami helps. I'd have to admit, if I was in, I don't want to pick on North Dakota, but I have a lot of respect for people in North Dakota who go exercise every day. I don't think I would be one of those people. So, and we do travel, as I said, 3 or 4 times a year, at least, to Europe, to Brazil. And it's a combination, which is good and bad. And that's sometimes how you have to manage it. We today have geographical flexibility, I think, liberty, but with the technology we have almost, and it's a challenge to turn off the technology because you're at work, right? So you're mentally thinking, and that is the thing. I think that's a challenge for all of us. One's personality, one's DNA. If you work hard, you're always generally going to do that. People ask me why I still work so hard, and I say, well, one, I enjoy it, and two, I think if you don't put in that extra effort, then things can go wrong, and that's not good. It's my money. I don't want things to go wrong. Um, balance is, I guess, obviously everyday physical activity. Today, believe it or not, I still play football or soccer. I'm gonna play with my friends in Brazil. I don't live here anymore, but whenever I come here, I play on Wednesday. We did this 30 years ago, and obviously I don't run as fast as I used to. But the secret is, if you play with people more or less your same age, if you were fast then, you're still fast relatively. So I'm, I'm lucky that way.
Very cool. Very cool. Great. Thank you so much for joining us today and sharing your insights. Again, I would love to invite you to our summit. It's going to take place on November 11 in Lisbon. It will
Thank you.
be very convenient for you with Portuguese, so you can practice it.
Indeed, indeed. It will be a
Yeah.
pleasure. I look forward
Yeah.
to seeing you again in
Oh,
the near future, Yuri. I always
yeah.
enjoy chatting with you.
Yeah.
Take
And
care.
also, Davos, we'll have a meeting again in Davos. So see you there as well.
I look forward to seeing you again and having hopefully a beer or a coffee together.
Thank you. Thank
Take
you,
care.
Russell. Have a great day.